computer. All right, now we're recording. So I am going to start with a quick screen share. Bear with me 1 second here. Screen share manual, and here we go. I'm assuming everybody can see this okay. Yep. So this presentation was really designed to scratch the surface of mortgages in 2021. And everything that we have here is relevant to not only the loans that Homestead Funding does, but the majority of the stuff that you will run into as a real estate agent. And like I mentioned before, again, if we get onto a topic that just seems completely foreign to you, there are no stupid questions. I've been doing this 16 years. I learn something every single day. So if we're covering a topic and you're like, Phil, I have no idea what that means, stop me. There's a lot of alphabet soup. Mortgage people love acronyms. So we're going to have an acronym for just about everything. And some of these you've never heard of before. So again, if I'm like LTV, DTI, blah, 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 you're like, Phil, I have no idea what the heck you're talking about. Just stop me, freeze me in my tracks. Let me answer it, because if you have that question, somebody else does too. So the idea today is just to talk about financing solutions. Again, the stuff that you will commonly run into as a real estate agent. Before we do that, let's talk a little bit about where we lend. And actually, before I go any deeper, this presentation is PDF. You will get a copy. I will make sure that they're sent to you. Paper copies will be sent to you to your offices via courier. So you'll have this as reference material later. And this stuff is super helpful. You can go back and look at some of these materials again. I will also be inserting a few other things that are not, boilerplate, presentation material. We'll talk a little bit about grants. I have a chart that I've created that kind of covers the home buying process. I'm going to cover some of the nasty stuff like foreclosures and short sales and how they can affect your buyers and sellers. So a few of those little pieces I'll just kind of be popping in here and there between presentation pages. So as you can see here, we lend in a lot of states. We're licensed in 45 states. Our corporate office is on Airline Drive, where your corporate office location is also. And if you have a client who's relocating from an area or to an area that's not in New York, we can help them in some capacity. So just let us know if you have some weird referral or some friend or family member who lives in Montana, where we have a license there and we'll help them. Homebuyer privileges. This is something that we've partnered with a company called Genworth, and they have some really cool homebuyer privileges, some savings things through companies like Target and Costco and Sears and such. So kind of fun, but that'll be in your reference material, and the codes that you can share with your clients are there. Whether they work with Homestead or not, it's still a free service we have. So let's talk a little bit about the buying process. And this is kind of scratching the surface of what I would consider a smooth transaction. Your first step before you do anything else with a buyer is ensure that they're qualified. And it's a hard thing because, Kelly, you might have, just judging by your face, you have a lot of friends who I'm assuming will, if they are not already, will be first-time home buyers in some capacity, because you look young enough to be my daughter. So I'm assuming you have young friends. And the hardest thing when you were working with a friend is judging them, right? Because that's inherently what a pre-qualification is. It's a professional evaluating someone's ability to get a mortgage. And it's a hard thing, especially as a newer agent, to quote unquote judge people. The good thing is this isn't the 1980s where real estate agents used to pre-qualify their buyers. You can now make us the good guy or the bad guy, right? We're the ones who say yes or no. And I don't like being the gatekeeper, but that's in essence what we are. We really kind of tell people if they have the ability to buy a house or not. And if they don't have the ability to buy a house, we don't just send them packing. We have some options for that. And I'll cover that in some later phase. But first and foremost, ensure your buyers are qualified. And you really want to make sure that they're qualified with a reputable lender. We would love the opportunity to work with every buyer you have, but we understand it's not realistic. So if you have buyers who would prefer their own lender, or if they've already come to you pre-qualified, that's fine. Just ensure it's reputable. And my recommendation is local and reputable, because in this real estate market, it's pretty conservative. The Capital District as a whole, which we all work in, is a pretty fiscally conservative market. People like, kind of the local feel, especially when it comes to all of the players. Is it a local attorney, or is it some, national attorney company someone used because they got some deal through their employer? Is it a local lender? That stuff's really important. And the value to a local lender is not only that they will likely have more people in the supply chain of handling the loan be local, but most importantly, the underwriter is local and the appraiser is likely to be local. And for us, that's absolutely the case. We do on-site underwriting, which means the decision makers for our loans are all either in the individual branches. Mine is Clifton Park, where I am today, or our corporate office in Albany. And the appraisers that we use are all local to the market. So if you have a Montana deal that you've referred to us, that'll be a Montana appraiser. But for 99.9% of the transactions you will be involved with, we're talking local capital district. So for us, we're using local appraisers. And the value with those two people, the appraiser and the underwriter being local to the market, means that they understand the market. And here's a good example. You have Clifton Park, which encompasses a lot of areas. It could be Half Moon, Clifton Park. You might have an area in the upper east side of Clifton Park that kind of gets towards Mechanicville. And maybe the price range of the home means the appraiser had to use comparable sales that were in Clifton Park, but also in Mechanicville or maybe Stillwater. Well, an underwriter who is reviewing that appraisal in Chicago may not understand the nuance of this, right? Why did an appraiser use 3 different towns for their comps? Well, there's a very, rational reason for that. $700,000 homes are not common to the capital district. So some of these little nuances are really important in making sure that, again, in that supply chain of everyone who touches the transaction, they all understand the components. So number 2, once you've received a pre-qualification letter, you want to read it. You want to ensure that that pre-qualification letter actually means something. What's the verbiage on it? Does it say that the lender has reviewed income, assets, credit, liabilities, work history? If that stuff has not been reviewed and it simply just says, congratulations, Mr. and Mrs. Smith, you're pre-qualified for $100,000. $100,000 what? Price house, mortgage? How did you review it? How did you get to that end result? The problem is that a pre-qualification is kind of a fuzzy term. It's up to the lender to decide what they consider pre-qualified. Now, there is a difference between a pre-qualification and a pre-approval. Does anybody know what the difference is between a pre-approval and a pre-qualification?
Pre-approval is something stated from the bank. A pre-qualification's more like, so pre-approval would be like more they run the credit and see what you're actually qualified for. A qualified letter is more like a letter stating you can go up to such and such amount.
Yeah, I'm going to give you like 80% credit on that answer because you were really, really close. And you're right. The distinction is that one is kind of greater than the other. Now, a pre-approval is when an underwriter has actually reviewed the application. So the consumer, can do a pre-qualification. The easiest way to get pre-qualified for me is just start with my online application. This is not a free plug, but most of us have our own domain names. You're nothing if you're not a .com, and at least in the mortgage business. So I own philreece.com. I've made the big time, but go right to that website. You can plug in your info, and I'm going to run credit. We do it as a soft pull, by the way, which is awesome for pre-qualifications. The consumer has to input their work history, their income, their assets. If I see that someone hasn't put in any assets, I'm going to call them and say, hey, you forgot to put in some assets here. Do we have some money in the bank? Sometimes the answer is no, and then we have to work on that. That might be something that is prohibiting them from getting an approval. But I fill in all those gaps, and then with my experience, I qualify that customer. And at Homestead, at least, you have, I would wager a guess, the average years of experience for most loan originators here is probably 15 plus years. So that the people who work for our company, for the most part, they're veteran, senior loan originators. We know what we're doing, which is good. I like that my colleagues know what they're doing because it helps my brand recognition. So I'm happy with that result. But a pre-approval means that the consumer has to formally apply. They fill out the standard industry mortgage application. They have to provide every document. I don't just say, hey, could you let me know who you bank with? Okay, it's FQ. You have $14,000 in the bank. You're great. We know what you're working with. I actually have to get those documents for a pre-approval, and an underwriter decision maker reviews the application. When an underwriter reviews that application, we are issuing a full bona fide approval. The only difference is its address to be determined. So you may ask, why don't we just do a pre-approval on every deal? Well, there are many reasons for that. One, there's a timeline associated with that. You can submit a pre-qualification letter now, and within an hour, there's a good chance I can get you pre-qualified. If we have to do a pre-approval, I have to submit that application through the entire chain. And that may take a few business days. So it's not a quick thing that we can do. Bear with me 1 second here. I'm going to admit one more person into the queue. Okay. The other thing is that there is a cost involved. It's not expensive, but it's like $60. You have to pay for the credit report fee to do the pre-approval. And the last thing is that that pre-approval is only good for a period of time. And after that, it formally expires and we have to re-up the documents. So the biggest issue, though, is that it just takes time. It's not a quick answer. And if you're looking for an answer on a Friday morning for a Saturday offer, you can't do a pre-approval always that quickly. Okay, step 3 for success. Encourage your buyers to work with a real estate attorney. And
can I just ask a question before we move on?
please,
Sorry.
no, this is perfect.
So does the time frame vary for pre-approval based on locale or company or whatever?
I think, yeah, the timeline for anything in the mortgage world will always vary based on company. I think the bigger the organization, the longer generally these processes take. Megan, you mentioned a really good point, which is looking at these pre-approvals, they're not all the same. In a lot of cases, you can have, and I like to pick on them because they're easy targets, but you can have a mortgage broker. And by the way, we're not a mortgage broker. We're a mortgage bank. We actually fund the loan with our own money. We underwrite and process the whole file. That means that it's all under our umbrella. And it holds us to a higher level of accountability because the entire transaction is on us. But most importantly, if we issue an approval, we're guaranteeing the funds will be at closing. Brokers are a little different. They actually place a loan with a consumer, and they have to decide which lender it goes to. And if that lender, again, is in Chicago, they have to send all those documents to Chicago, and there's that offsite underwriting, that whole thing. There is some value to being a broker in that they can kind of shop programs and rates, but we sort of do that too, because our rate matrix is either going to be loans we service or we sell to an investor. Getting way in the weeds, but the thing is, you can have a broker who issues a letter and they're saying, congratulations, you are pre-approved. We even do see this sometimes from some local banks. I know for a fact that that loan did not actually go through underwriting, but there's no enforcement. So legally, a lender cannot say you are pre-approved unless it's gone through underwriting, because I'm not a decision maker. I wish I was. I'd approve every loan I could because I'd make more money, but I'm a loan originator. It's my job to do something different. I cannot legally say you are pre-approved. Only an underwriter can do that. HUD just doesn't enforce it. So we're not going to play that game and do what some other people are doing. So Megan, take it with a grain of salt. Always verify the source and ask questions. Talk to your colleagues. Which branch are you out of?
I'm going to be in the Greenbush office.
Excellent. I think that is Janet who works in that office. If I'm wrong, I apologize, but she would be like your loan originator for your branch. And if it is Janet, she's great. And if you ever have a transaction where you're not really sure about the letter itself, just send it to Janet. I review those things often from people who are like, Phil, I've never heard of this bank. Could you just take a look at this? And I can generally get a sense on the quality of that information. And, we'll be honest, if it seems legit, hey, great, this is legit. If your client wants a second opinion, we're here for that too. We're not going to lie to you to get the business. So does that help?
Yes.
Okay. I know I went a little deeper than your question, but you had a good question. So, okay. Step 4, when the loan is actually in process, you want to request a copy of the commitment letter. We, as a lender, will send it to you. So this is common practice for us, but if you're part of the transaction, especially as the buyer's agent, we're going to send you a copy of the commitment letter. And the commitment letter is a full approval. That's when your client's gotten through about half of the loan process. They've done the approval. At that point, we're probably likely waiting for the appraisal and title and just clearing any remaining conditions like, homeowners insurance and that kind of stuff. So I think it's important to take a look at the actual commitment letter and see what conditions remain. You are not always going to have easy deals. Sometimes you refer a client to us and their credit score is 621 and they're getting a gift from 3 family members and they're self-employed. So there's a bunch of extra documentation and that commitment letter might have 12 conditions. The underwriter says you're approved, but you have to give us these 12 remaining things before we can actually send you to closing. That's not typically the case. Most commitment letters usually have just a handful of things in their title, appraisal, and typically a couple of small things, maybe a pay stub or something. But you have some tough deals, and it's good for you to know that, because if you see a bunch of conditions, you want to check in with your client. I don't want to paint things with a broad brush, but generally speaking, I think the people who have loans that are a little rough around the edges sometimes need a little more handholding. It's probably why their loan is a little rough around the edges. So if you can be that person supervising the transaction, which I think the realtor's role really is, you're kind of the glue between everybody, right? You've often recommended the lender, you've recommended the attorney, the inspector, and I think some of those recommendations fall on you. So it's always important to kind of be a little more hands-on, especially with those rougher transactions, and just make sure that your buyer's getting stuff to their lender and they're doing it in a timely manner, and it helps us out tremendously. So, okay, this is the buying process. And this is where I'm actually going to shift gears for a second, because I'm not a huge fan of that chart, although I think there's some value in it. One, it's like this, and you're going to have to go to the chiropractor if you look at it for a few minutes. So we're going to skip this one. And there's a bunch of stuff in here that's kind of obvious, but what I'd like to do is talk about this one. And Ray, just give me a thumbs up if you can see this chart here, loan process. Thanks, man. So this is something I've created personally, and I give this to clients who are starting the application. So let's assume you sent us a client 2 months ago. We qualified them. They've looked at a zillion houses. They've had their uncles, cousins, best friends, neighbors, family member come over, and everybody under the sun has all come to this one house, and they've all said it's the perfect house for them. And now we're under contract. So the one thing you want to remember, this is really, really important. Tattoo it on the back of your hand or find some way that you can remember this, but this will happen to you, especially if you're a newer agent. Do not forget to send a copy of the purchase contract to the buyer's lender. I'm going to repeat that again. Do not forget to send the contract to the buyer's lender. What happens a lot, especially when you're new, is that exuberance. You're happy, you're psyched, you've got your first deal, or maybe it's your 5th deal, and you're getting some momentum in your career, and you tell your buyer, okay, go apply for their mortgage, and they forget because they've talked to their attorney. They have to go through attorney approval. They're scheduling their inspections, and they got pre-qualified 2 months ago, and they forgot that they have to start the loan process. The inspection and the attorney approval generally happen pretty quickly. The only thing preventing you after that from getting to closing is how quickly your bank can close you. But if the buyer forgets to apply, it's going to delay the process. So make sure your buyer applies. And the best way to do that is really, if you have a relationship with the loan originator you're working with, I think it works best. For instance, Ray and I are working together, and Ray has a client, and we've qualified him, and Ray sends me the contract and goes, "Hey, Phil, the Smiths are under contract." I'm like, "Thanks, man. I'm calling the Smiths now, and I initiate that loan process to make sure they can get through. So this chart shows what my process looks like because it's foreign to you. You don't always see what happens here. And again, I'm going to try to send this out to everybody. So I'll get the list of everyone's emails from Ryan, and I'll send this with the other material for you. So my job at application as a loan originator is, and this is pre-COVID, was to meet with the buyer. I do very few in-person meetings now because one, people have just learned it's more convenient to do things electronically, and we have awesome systems and it just works easier. So, but I meet with them theoretically with a phone review. And they send me their paperwork, I review it, I make sure it's good. And once we're good there, I send the loan into opening. Now, a loan opener is a person you've probably never even heard of. Their job is to basically take all of the information that the consumer's given us and all the signed documents and basically just pretty them up in the system. And then they submit the loan to the next phase, which is processing. And a loan processor is, to me, the most important person in the transaction. They're actually involved in like 4 of the next phases of this loan process. And the loan processor's job is to look at every single document submitted, analyze it like I've done, which is a second set of eyes, and ensure that we have enough income and assets and documentation to support this file. We have to make sure that before we send it to underwriting, it's good. So if anything's missing, the loan processor's job to kind of reach out to the client and say, hey, Smiths, we're just missing a few things here. It could be something really kind of dumb, but like we're missing a few pages of a bank statement. We have to fill in all these gaps and have it all ready. Then the processor submits the loan to underwriting, and they'll work with underwriting if there's any questions during that process. And underwriting can issue one of 3 things. There's either approval, denial, or suspense. So an approval, obvious; denial, unfortunate but obvious; and suspense, which is a suspended loan. It's not a bad thing. It's like mortgage purgatory, right? What happens with a suspended loan is that the loan needs some work. And with some banks, they tend to lean on either of these 2 things, approval or denial. But with Homestead, we have a little bit of a different corporate culture. And our underwriters are awesome. I mean, they have to live up to the corporate, to the industry guidelines and the rules of the mortgage industry and the loan that the consumer is using. But we try to think outside the box, and our underwriters want to make loans work, right? They don't like issuing denials because any mortgage company is going to make money if we can close loans. It's the only way that we actually make a profit. So our underwriters will look at a loan that may be a little rough, and they'll say, hey, you know what, there's a couple things here. We've got some hair on this. Can we think outside the box and be a little creative? And that's where it may involve some things like adding a cosigner or something. It's very rare for a loan to get through to that because our approval rating is well into the 90s. So we have a really good record. And then when the loan is approved, it goes to the next phase, which is the commitment. That's when the commitment letter is sent. You get a copy of the commitment letter, you review it, and it's up to really the lender and the buyer to work on those remaining conditions, but it's always good for you to know what's going on with them. When all of the conditions on that commitment letter have been met and we receive them, we have a copy of the title from the attorney, and the appraisal's done, we issue a clear to close. And this is a great task. My processor loves sending out the emails. Congratulations, you're clear to close. She's done her job. And at that point, the loan pretty much is in the hands of the attorneys. And that's the last phase, which is scheduling. And for most lenders, scheduling has about a 3-day lead time, as it does with us. Some banks can be more, but with scheduling, if we clear a file to close on Monday, it can close as early as Thursday. And the reason why, there are a million people involved in that final process. You often have a bank attorney, a buyer's attorney, a seller's attorney. You have the buyer and the seller. So you have to coordinate the scheduling of all of these 5 parties, right? How does everyone, if you have 4 friends and you all want to go out to dinner, you can't even decide on that like 3 weeks in advance. But somehow these attorneys can get everybody scheduled on the same date and time and make it all work. Then on top of that, all of the attorneys have to agree on all of the figures. Does everything match? Do we have every gap filled in? Do we have, let's say Craig is the selling agent, and we have Ray as the buyer's agent. Does everyone's commission statements in? Do we have every piece of data? You can't have anything missing going into a closing. So all of that has to be reviewed, approved by all the attorneys, and that's how that process works. So that is the loan process. And it differs from the whole overall process of like walkthroughs and all that stuff. And a lot of that. So that'll be in that material you can look later. All right, just a few helpful tips. I'm going to kind of go through a few of these. They may be hard to read. I'm not sure how it looks on your screen, but one of the biggest things, and this is not for you. These are helpful tips for buyers, just more of an FYI for you. The number one thing is respond quickly when asked for information or documentation. That's the biggest thing. Buyers often can just kind of delay that process. They get, they've already applied. They feel like they're under contract for the house, and it's sort of that initial sense of satisfaction, like I'm done, right? But there is stuff that has to happen. So, if we ever require some prodding, I know the realtors I can go to who are like, kind of like, they don't mind like, whipping their clients a little bit into shape. I'll be like, hey, Ray, can you just give the Smiths a call real quick? And, we're really trying to get a hold of them and they're not responding. And Ray's like, yeah, absolutely. And, within like 3 hours, we have what we need. It's always magic when the realtor gets involved. Try not to, but we may have to lean on you for that. Hire an experienced real estate attorney, super, super important. Call your loan originator with any questions. We tell our buyers that all of the time. The only number I ever give people is my cell. Again, Ray can attest to that. It's how you can reach me, and that's pretty much par for the course with any good loan originator. If you're working with a loan originator whose only method of communication is email and like some office number, that's a big red flag. You should be more accessible. It's 2021. Explaining any unusual large deposits. This is a big bone of contention. People get weirded out when a bank says, hey, can you give us the source of a deposit? That was $6,000 2 weeks ago. We're required to, by law, verify these things. So there are reasons why, banks do what we do. We don't do it because we find enjoyment in it. They're just kind of requirements. So let me take a look here. Yeah, some of the other stuff we kind of covered before. So I'll let you kind of peruse that when you have a second. So let's go into alphabet soup, because these are terms that you're going to run into a lot. Okay, let's see here. Craig, I'm going to pick on you for a second. If you have a loan that is 20% down, what's the LTV? And that's LTV stands for loan to value.
So is it 80%?
Exactly right. I don't know why this is, but in the mortgage world, we love our terms and our acronyms, but we use the phrase LTV for everything. So if there's a 3% down loan, we look at it as a 97 LTV. Or if there's 5% down loan, it's a 95 LTV. And you might run into that word or that phrase LTV sometimes, but it's really important to know because it's just the opposite of down payment. And it's just one of those very commonly used phrases that's completely commonplace for me every day as a mortgage nerd, but for you and for everyone else in the world, no one ever uses the word LTV. We always focus on down payment. So just know what that phrase means, and you got it right. I'm not going to pick on anybody for the next one. This is ratios. This is a little bit of a hard one. So ratios are the most important thing in determining how much house somebody can get. And what ratios are is basically your income divided by your debt. Actually, technically the other way around. Your debt divided by your income. This tells me what I can lend for a house. Each loan has a different rule. So you may have, for us, now I'm going to quote Homestead Funding rules for a moment. You can have a 620 credit score FHA. The maximum debt to income ratio I can do is 45%. If you're above 660, I can do 55, sometimes more on an exception basis. Conventional it's usually around 45, but I've had some go as high as 49%. I have to know all of these ratios. There are different rules for USDA, different rules for VA, different rules for Sunny Mae, which is New York State conventional program. I have to know these ratios and know them cold because they are super important, because that determines someone's ability to buy a home. If you have higher income in low debt, you are in the low debt to income ratio bracket. And that means that I can lend you a lot of house. We use an example. I don't know if this math actually works, so pardon me, I'm making it out of thin air. But someone makes $100,000 a year and they only have one vehicle loan that's $500 a month, and they have marginal credit card debt, no student loans, so they're in a good place in life, right? They may be able to qualify for a $380,000 home with taxes of $8,000 a year. Don't know, but probably pretty close to reality there. You can have someone who makes $120,000 a year. They're making more money, but they have 3 vehicle loans. They have a ton of student loan debt, and they don't use their credit cards very well. Because they have a lot of extra debt, they may only qualify for a $290,000 home because it's their debt to income ratio. So when someone says to me, how much house can I afford? It's a bit of a loaded question because it's actually based on payment. In reality, we can probably approve someone, with that $100,000 low, debt scenario to maybe a payment of $2,800 a month. We use that as an example, right? But how do we get to $2,800 a month? That could be, a $450,000 house with low taxes, or it could be a $300,000 house with high taxes. So sometimes there's a spectrum, and a lot of the questions that good loan originators ask are not just the required questions like, where do you work, what's your income, how much do you have in the bank, but where do you want to buy? I know that some of you work in different counties, right? So if you're looking at Schenectady County versus Niskayuna as an example versus the town of Colony, we all know the town of Colony has really low tax rates, a lot of commercial construction. So, with a lot of commercial construction, the commercial real estate pays for a lot of the tax base, which is awesome if you're a homeowner. But if you live in the town of Niskayuna, you have higher taxes. So the taxes are going to affect that payment. So it's really important for me to know kind of an area. And again, local, reputable, when it comes to lending, those little details matter. If I'm licensed in the entire state of New York, but if you're asking me to do a loan in Plattsburgh, I don't know the customs and norms. I don't know how the contracts are done. I don't know how the attorneys are involved or reasonable taxes I should use. I'd have to go online to do that. I'd have to look at Zillow to do all that. It doesn't make me an expert in that market. So my business is primarily in the Capital District because I'm an expert in that market, or at least I think I am. You could be the judge of that if we work together. Credit scores, those are very important too. You have to have a minimum score. Some local lenders, actually most local lenders in the area, will probably go down to 640. We go a little deeper to 620. You may find some that even go down to 600 or 580. That's very rare below 620. But for the most part, you need to have, low 600s and up to get a mortgage these days. And if you don't, you need credit repair. And we have options for that. We have an affiliated credit company called Credivolve. They have an excellent reputation. We send clients to them and they work with the consumer to kind of get them where they need to be. So the next in the bit of alphabet soup would be conventional, VA, and USDA, and FHA. And all of those are different programs. So conventional just means that it's a regular mortgage through a regular bank. And the insurance, if required, because we'll assume less than 20% down, there's PMI. That private mortgage insurance is through a private company. So this is conventional, it's all private. There's no government arms involved other than just the regular banking regulations. When we talk about the FHA, the VA, and the USDA mortgages, which we will definitely kind of nitpick a little bit of those later, those are all government insured. So FHA, for instance, is insured by FHA and HUD. Yeah, everyone's heard of HUD. You've all gone through training, kind of know what HUD is, but HUD oversees like everything. So they have their own insurance through the Federal Housing Administration. That's what FHA stands for. It's not a first-time home buyer anything. You don't have to be a first-time home buyer to do FHA. In fact, you can own another property and still do FHA. You just can't have two FHAs at the same time without really the right reasons. It's super hard to do that. VA, military veterans, and USDA is for rural houses. We'll talk about that later. You have closing costs, which are obvious. Everyone knows that there are closing costs, and prepaids. But what you may not be aware of is that they're expensive. And when you're working with younger first-time home buyers who have no knowledge of the mortgage industry, all of this stuff here, the closing costs and the prepaids, are where people get completely freaked out. And for good reason. They are way too expensive. But we all live in New York State. New York State has the privilege of being the highest closing cost state in the United States. Go us. So our challenge in working in this state is that, one, we have higher real estate taxes, and there are more fees. One example of that can be pretty expensive is New York State mortgage tax. Albany, Schenectady, and Rensselaer counties have a 1% mortgage tax. So if you're mortgaging 200 grand, you're paying New York State 2 grand in your closing costs for the privilege of getting a mortgage and buying a house. Awesome. So the problem for most younger first-time home buyers is they go online and they use the Google machine, and it tells them FHA is 3.5% down, and they save money for 6 months, and they get that money together, and they're looking at a $200,000 home, and they are psyched because they have saved 7 grand, and that is awesome. And I hate to be like the big wet blanket here, but they don't realize that there's another $12,000 in closing costs. Very easily can happen. Now, it can be 10, it could be 12. It really depends on the county. But you have closing costs, which could be maybe 5 or 6 grand. And then you have prepaids, which is paying for setting up basically your tax escrow and buying your homeowner's insurance for the first year. So if your taxes are 5 grand and your homeowner's insurance is, let's say, $700, on top of your closing costs, you're bringing another $5,700. So you can see how easily you can get to that $10,000 number. So when someone thought they had the 7 grand they need, and then they go to a lender and they say, sorry, it's like 17 grand. That's when it's the OS moment, right? We're like, what do we do now? Well, there are some creative ways, they're not all ideal, but you can use retirement. People can liquidate investments. They may have some bonds that maybe their grandparents gave them or something. That's totally okay. You can get a gift from family. That's rad if you can, right? But we're totally cool with it. It doesn't matter what loan program, we will allow gifts on anything, unless it's an investment property. But that's not the kind of transaction we're talking about here. And the last but hardest scenario in this current market, which hopefully will change soon, but because it's a seller's market, you can do a seller concession, which is the seller paying for as much of those closing costs as you can negotiate. So you need to learn how to be a really good negotiator if you have a buyer who needs seller concessions. But the market's starting to shift. I think we're seeing signs of returning to some normalcy. So hopefully when that does, there's more inventory and less demand. So there's less competition. You'll have buyers who need seller concessions successfully winning that. Okay, let me just take a look at some other stuff I have. I want to make sure I didn't miss anything. Okay, good. So we are good. I'm going to insert a few other things later as we go along. So conventional financing, this is going to make up about 50% of all of the loans that you will do. They are conventional, straightforward mortgages. To use a local bank as an example, Trustco Bank, they are only a conventional lender. They do not do FHA, VA, USDA. They do conventional loans pretty well. I will give them credit for that. And then you can look at the local credit unions, right? SEFCU, Sunmark, Capcom, all good reputable lenders. But they'll do everything like we will. I think we do it better, but I'm a little biased. But that's the difference between working with a bank that is an old-fashioned savings bank, like a Trustco, who's only going to do conventional, and a bank that only specializes in mortgages like Homestead Funding. We do every single loan out there, but you'll run into this 50% of the time. So for conventional financing, single family homes, max financing is $548,000. We can do over that. It's called a jumbo loan. And we have an awesome jumbo program. Our rates are extremely low. I don't think anybody in the area is beating us on that rate. And we can do as low as 10% down for jumbo. So for those $1 million listings that you're all going to be going after, if you have a buyer who's going to buy one of those homes, we can finance the heck out of that and actually have some really competitive products. This does say the first 5% down payment must come from the borrower's own funds. These are just some of the guidelines. You don't have to get deep in the weeds here. Most conventional mortgages, minimum down is 5%. But if you're a first-time home buyer, you can actually do conventional with 3% down. I'll talk about why you would still go to FHA at 3.5, but I'm going to do that later. So traditionally, conventional, you're thinking single family, owner occupied, or investors. They're all going to go conventional. Most commonly, the buyer for this program, excellent credit. If you kind of have iffy credit or some other factors, you may fall into the FHA sphere. We'll talk about FHA in a moment. Home Ready. This is the 3% down program that I alluded to. It's a great program. It's really designed to be for first-time home buyers. It can fit other people, but you have to make sure you meet the right criteria for it.
Hey, Phil.
Yes, sir.
All righty. You were doing an absolutely amazing job, but I have to go run and pick up my little guy. So you're all in good hands for the rest of the day with Phil. And then I will see everybody back Monday morning as we work with new buyers and everything like that to kind of expand on Karen's class and the open house stuff and all that fun jazz. Both recordings will be up and live on YouTube. I'll post them on the Facebook page later on this evening. Have a great rest of the day, everybody.
See you
Thanks,
later.
Ryan.
All right. So this program here is through Fannie Mae. It's Home Ready. This one is through Freddie Mac. Fannie Mae and Freddie Mac, in case you ever hear of them again, they basically just create the rules for conventional mortgages in the United States. So if you hear either of those, it's basically just, the rule makers. That's all they are. Okay, we're going to keep going here. All right, this is a really cool one. So you may run into either a listing that you have. That's a bit of a diamond in the rough. You may see in, some of the creative agents will say, home with awesome potential or needs a little TLC, like red flag. It means it's probably going to have some inspection and appraisal issues. We're all salespeople and we like to kind of, try to polish it up a little bit. If you run into those transactions, you may want to leave some of these materials in the house. So, if Craig, you have a listing and it's very clear, it needs some work. It could have this here, right? Some exposed walls. Some previous homeowners started a transaction. Started a renovation, and then they got divorced. Maybe it was a renovation. They got them divorced. Who knows? But they got in over their head, and it's not working. And they're not going ahead with the house. They're just going to sell it as is. Actually, if you see as is in a listing, another red flag. But if you have that listing, you want to include some renovation material in the home because people aren't aware there are mortgages for that. So this is the conventional version. We'll talk about the FHA version, which is actually more common, but Fannie Mae has this awesome product. You can do 5% down. You can actually bundle it with this program, Home Ready, and do 3% down. So you can do 3% down and then also cover your renovation costs. So what a buyer does is they buy the home, we'll say, example, $100,000, and they get a contractor to provide an estimate for the work. We'll call that $50,000. And we have to leave a little set aside on top of that. They call it a contingency reserve. So we'll use easy math. We may base everything off of $165,000. So that's our total start of our project cost. And the buyer brings 5% down based off of 165, not 100,000. So we're allowing the buyer to finance almost all of the renovation work into the home. And the cool thing is they can close, buy the home in its current condition, no matter how bad it is. The work is all done after closing. We give everyone 6 months to complete the project. So if you have a home or you're working with a buyer who's looking at a home that has TLC as is, home with great potential, they can buy that home and close as is, as long as they qualify for this program or another one that we'll talk about.
Is that more like the FHA 203K loan?
Yeah, you nailed it, my man. That's exactly it. So the 203K is the FHA version of that. And it's actually the more common version. There are pros and cons to both. Once we get to the 203K slide, I'll give you the differences, in my opinion, on both of those. I specialize in renovation loans. So if you ever have questions, even if we're not involved, even if you have another originator you work with, and I don't have a chance of getting that buyer because they love their bank, just ask me a question, just call me. I don't mind. It takes me 5 minutes to answer, and I love to teach, so it doesn't matter to me.
Joe, I have a quick question.
Yeah, man.
So you had mentioned, 6 months to complete the renovation projects. Is that the same for, say somebody's doing a FHA 203K on a 2-family and they're going to be owner occupied?
Mhm.
Did they get the same 6 months, or did they get longer if they're owner occupied?
Okay, so that is a good question. Traditionally, all of the renovation loans, we're pretty much talking owner occupied here. So the owner occupied thing would not really be a point of distinction for any of those guidelines. Technically, you can do a home ready. Let's see here. Let me just take a home style. Man, I'm getting all these home products mixed up, and I said I'm an expert. So the home style, it may not even say it on here. Maybe it does. Yeah, it does. 1 unit investment. So technically, you can do a home style renovation loan as an investor. So that's non-owner occupied, but it's only for single family homes. So Chris, to your point, if it's a 2-family property, you don't really have an option for investment. Any multifamily,
Gotcha.
You're pretty much talking owner occupied. So the buyer has to occupy the property. Now, 6 months is the stated guideline. That's the amount of time that either FHA will for the 203K or Fannie Mae says that is allotted. The world went upside down last year, and it's not back to complete normalcy. So, if a project takes a little longer, we'll work with people, but it just can't be like, it can't be an 18-month project. At some point, we're going to be like, you got to fire this contractor. If they're not showing up to work, you could build a house in 6 months. There's no reason you can't do a renovation in that amount of time. Okay, so jumbo, we do this program up to $1 million. I mentioned it before, super competitive. Craig, you've got that 90% LTV again, so 10% down. So that's how that program works. It's awesome. So if you run into anybody who is in the upper sphere buying these absolutely gorgeous houses like this, we can completely help them. Sunny May, New York State program. It is actually conventional. And one thing I didn't mention back in an earlier slide when we were talking about the beginning of alphabet soup, and I said, you have all these programs, conventional, FHA, VA, USDA. And I mentioned a few things, and I was like, yeah, don't forget some of these. One more point that you don't want to forget is, okay, and Chris, if you can answer, if you can't, I will give you a few seconds. If it's dead air, no worries. But are there any issues with condos in certain types of financing?
Ooh, I don't know the answer to that one.
Oh, I thought I gave you a layup, but this is a tough question. I only did because I think you have the most experience on here, with the exception of Ryan, who's gone for the day. But okay, FHA in condos, oil and water. If at all possible, if you have a buyer who's looking at condos, try to discourage them from using FHA financing. And here's the reason why. Condos have a different ownership than a regular home or even a townhouse. With a condo, you have this big box and they're slotted into units, and the buyer only owns from the walls in. The condo association owns the outside of the structure. So they own the entire building. So basically it's like renting in a way. When it comes to ownership, you don't own the outside. You don't own any of the common space. You may not even own the deck. You don't own the stairs. You own the unit in. And your insurance is actually just like renter's insurance. It's basically just for your contents and belongings. And, if your unit went on fire, what would it cost to replace the carpet and the cabinets and the contents? But it's not like rebuilding the entire home. The ownership is owned by the association. So when it comes to association ownership, FHA does not really feel comfortable with that process. And one of the reasons why is they just don't want the exposure. If they opened it up to everybody, FHA is really designed to be what I would jokingly call the Ellis Island of financing. They take in almost everybody. They don't really have the strict rules that conventional financing does. And to that point, a lot of like move up buyers, people who are renting and now looking at home ownership as their first opportunity, maybe looking at the FHA product because it's very lenient and has some really awesome features. So if FHA opened up complete use of that program for condos, you would run into an issue where FHA would have a lot of exposure. And if that condo association, the whole association that owns the structure, goes belly up, which can happen. Some condo associations fail. It's not common in our area, but we've seen it in metro areas and other places. FHA runs into huge exposure. They can potentially lose like 12 different individual loans go into default, and that's a lot of risk for them. I don't agree with it, but it is FHA's rule. So unless a condo association is approved already through HUD, FHA won't do the deal without an exception. And getting that exception is you might want to do your own root canal. That's how much fun they are. So try to avoid FHA in condos. So you're looking at, what would be an alternative to FHA? And this could be a really good program. The other one that we mentioned before can too. Home Possible, Home Ready, 3% down. Now, the cool thing about Sunny May is it's conventional financing, New York State only, and 3% down, 97% LTV. The difference here is that Sunny May's rules are a little more lenient in some ways, mostly with things like credit and the amount of money. It can actually be as low as 1% down, which is insane. There's some stuff that you can do to do that. I'm not going to get too deep into the weeds, but Sunny May can be an awesome program and an excellent alternative to the FHA product. It does have some negatives. It is underwritten through New York State. So you have a bank who has to approve the loan and then send it to New York State for their review and their underwriting and their approval. And that process takes longer. So it's not a quick close. I could do an FHA in 30 days if you needed me to. I can't do a Sunny May in 30 days. I'm subject to their timeline. So you're going to have to just have a little flexibility in your closing dates to accommodate a Sunny May. Okay, FHA. And then I think after that, maybe take a 2-minute break. So FHA, again, stands for Federal Housing Administration, not first-time homebuyer something. It's an awesome program for first-time homebuyers, though. And there's a reason why. And it has to do with this guy here. FHA allows sellers to give up to 6% of the home's purchase price to pay for closing costs and prepaids. So this is the big distinction between all of the previously mentioned conventional products. Those programs do 3% down, but the size of their seller concession is only 3%. So with this program, their down payment is 3.5% instead of 3%. And you would think it would be more money out of pocket. But even though it's a 0.5% more down payment, if the seller can kick in towards closing costs, this 6% number makes all of the difference. If we talk about the $200,000 home that I talked about before, and we said the closing costs are 10 grand, theoretically, the seller can contribute $12,000. That's 6% of 200,000. So if the seller is willing to, and you can negotiate it. In that scenario, that seller can pay for all of that buyer's closing costs, which allows them to get into the home with the $7,000 that I had mentioned they had saved. If you did conventional financing, the seller could only pay for $6,000 because it's 3% of 200,000. So they would be short. They would still have to come up with their other $4,000. And for some people, that may not be possible. So when we're looking at using the seller concession as much as possible to get a buyer into a home with the least amount of money, and we don't have alternatives like VA or USDA, which we will talk about, this is the product to do it. The other thing too is that it has that low down payment of 3.5%, whether it's a single family or a 4-unit property. So for someone who is really smart and thinking, for my first home, I'm going to own or occupy it, and I found this great 3-unit, and I want to rent out those other 2 units, they can absolutely do that. And then they could theoretically live in the home for a minimum of a year, or they can go 4 years. And if they decide that they want to convert that unit that they're living in to a rental and keep that property and then buy their own single family, you can do that. FHA is completely okay with that. They will allow for what's called an investment conversion, as long as the buyer occupies the property for 1 year. So try to remember that. And that's actually a good thing for you to know. And bear in mind too, if any of these guidelines, I would always throw out a disclaimer. Here's what I know, right? Which I think is a smart way to say it. Someone asks me like, hey, Phil, I have 2 people on a deed, and if one of them passes away, what happens to the home? And I'm like, I always say, here's what I know. I give them the answer, and I say, well, if you really want to confirm, just make sure you talk to an attorney. And I think the same should apply to you. Like, here's what I know. But if you really want to confirm what I'm saying is correct, I have a mortgage person to talk to. But if you have a buyer who's like, yeah, I want to get a multifamily for my first home, how long do I have to live in it for? The standard for a lot of years has been live in it for 1 year, and then they can go do their own thing. If they do it in 6 months, that is an enforceable thing. So you want to make sure that your buyers don't do that. You can't control their actions after closing, but be careful about being involved in that type of transaction, because that is technically a prosecutable thing. So as long as they live in it for a year, totally cool. But that FHA program is brilliant because that's concession. The fact that they go down to low credit, again, with us 620, they have a high debt to income ratio, 55%. You're limited to 45 or 50 in other programs. It's really, again, the Ellis Island of financing. They're pretty much taking everybody. They have a lending limit too. There is no jumbo option for this, so you have to stick within these limits. But single family in New York State, 356,000. If you get into the multifamilies, it goes to 456, 551. You're not going to run into these unless you're maybe in like Saratoga County. You might get into those like upper ends for the multi-units. But 356,000 is the maximum amount that FHA will lend. So if you do the math on that, which I've done a zillion times, if you after down payment, this is the loan amount. So after down payment, you'd be looking at a purchase price of like just under 370. So, right now with the current standards, FHA is purchase price of 370 and less, which is a lot of house. It's probably more than what we probably need for the area, but we'll take it. Okay, there's an energy efficient mortgage. We can bundle some replacement stuff in there, and the 203K. So this is a good place to pause, take a break, go to the bathroom, grab some water or something. We'll hang here for a couple of minutes. So give yourself a quick reminder for about 2 minutes. And if anybody has any questions they want to ask in the meantime, I'll be hanging. All right, I'm just going to give Ray a second to come back, and then we'll get started. And there he is.
Sorry, quick phone
None.
call.
No problem, man. All right, let's hit the 203K. We talked about the renovation loan before through Fannie Mae, which is called the home style, but the most commonly used is the 203K. And this is a great example of what the 203K and actually the home style can do, but more so the 203K. You're allowed to finance more renovation costs with this program than you can any other renovation program. And it has a lot of other benefits of just being more flexible for renovation use. Now, you may choose one over the other. Usually those decisions are made based on someone's credit score or down payment amount. So there are some nuances. The factors that make the decision are typically more based on the buyer's general financials than the actual project itself. But you can, with a 203K, buy a home that's 50 grand and put $200,000 into it, as long as the appraiser says that the after improved value is 250, because it has to be that. You can't build the Taj Mahal in the center of Schenectady. It's not going to appraise. There's no comps to support the Taj Mahal in the center of Schenectady, as much as it would be rad for the center of Schenectady to have the Taj Mahal. It does have to have comparable sales. So this could be a great example. This home, which is, looks like a nice, cute starter home that, we'll say is 1,400 square feet, has become a very large home. Well, I'm assuming is for a growing family. These are the exact same houses, just completely redone. So the buyer can purchase this in its current condition and turn it into this. And the way they do that is to hire an outside contractor. So there are no standard mortgages. When I say standard, yeah, you can find anything out there. You find a hard money lender or some other weird, wacky thing. But in the standard mortgage industry, there's no such thing as a renovation loan that will let the buyer do the work, just so you know that. So you have to make sure that if you have the handyman or the contractor is like, I want to buy a fixer-upper and I'm going to do a renovation loan, they're not going to do it, because that person, they know how to swing a hammer. They're not going to pay someone else to do the work. They're just not going to do it. So the problem for that person who's looking to do a self-build is that they're going to have to find some other avenue. They may have to find a home that may be visually rough, but will pass an appraisal. It just has everything outdated. And as such, the value's low. But if it has, stuff that's deferred maintenance and mechanical issues, they're going to have to hire a third-party contractor. So really, this type of program is designed for homeowners who want the work to be done, and they're going to pay someone else to do that work. And again, 6 months to build. You can finance, a zillion costs. The only thing you can't do are things like luxury items. You can't install a pool or a hot tub or anything like really awesome like that. You can't buy TVs for the house. We're talking about permanent structural improvements to the property. Okay, seller concessions. We covered this. I think we covered a lot of the seller concession thing, but I didn't do a very thorough review. I don't want to keep you too long on this topic because, it is a little mind-numbing sometimes when you think about it too much. But that said, does anybody have questions about the seller concession in general? Anything that I can answer for you? And if you don't want to answer that question, or if the answer is no to that question, have you guys covered seller concessions already in your training?
I mean, I've been through it a couple times, talking about it a lot. We have talked about seller concessions. I think it was the first Monday, no, the Thursday that week we were covering. We were talking with George.
Okay. All right. Awesome. George Slingerland, I'm assuming, right?
Yes.
Okay,
Yeah.
perfect.
Slingerland.
So the seller concession thing is so commonly used. It's paragraph 6, page 1 of your purchase contract. I mean, if something's on the first page of a purchase contract, it's pretty important, right? Because the closing date you don't even find until you get to the next page. So it's a pretty important thing, and it's a tool that up until the beginning of 2020 was just completely common practice. recently it's gone away, and it's really been a hardship for buyers because that person who, again, saved $7,000 and then the bank told them 17,000, and every seller was getting 15 offers within 4 minutes of listing their house on the market. It became a problem because buyers just were out. No seller in their right mind was going to pay for 10 grand of someone's closing costs when they didn't have to. You could list a geodesic dome and you'd sell that thing in like 3 minutes. I mean, the market has been insane. And again, it's starting to shift back towards normalcy. So I hope it does, because I only work with buyers. So for me, I think that that's a win. But seller concessions are the easiest tool to have a buyer get into a home with less money. And the example used here is a purchase price of $106,000. So let's assume that the house is listed for $100,000 and it's FHA financing, and FHA says you could do a 6% seller concession. So we increase the price of the house to $106. And by doing that, we've now rolled $6,000 of that buyer's closing costs into the price of that home. The only caveat, the important thing to remember here, is the house has to appraise for 106, not 100,000. So everything always has to appraise for its purchase price, not the loan amount, not the amount without the seller concession, the total purchase price. So if that home is listed for 100 grand and it's pretty much listed at the height of what you thought the market can support, just let your buyer know, could be a little riskier, but we're going to try and see what the bank appraiser says. Another good reason to work with a local reputable lender. Those appraisers know the markets and they try their best to achieve the value in that purchase contract. So that's how a seller concession works. This is a bit of a trick question, but who calculates the seller concession?
The buyer agent, I believe.
No. Unless you are a licensed loan originator, I would recommend you don't ever calculate the size of the seller concession. It's all on me. Your lender, the buyer's lender, should be doing it. You should never pick a number out of thin air. I would never just automatically say a 6% seller concession, because depending on the price of that house, maybe that buyer only needs 4%. And if you went in with 6, but if you lowered it to 4, maybe you couldn't have gotten the house for a little lower price, or you weren't asking for as much of a concession. So you could have thrown in that extra thing you were trying to negotiate for the buyer. Have your buyer's lender calculate the size of that concession. I figure out the concession that's needed to the dollar. If a buyer has 12 grand that they have in total, but the total costs are 17,000, we're short by 5. So I'm going to tell you they only need a $5,000 seller concession. I'm going to keep that number to the minimum necessary, because I know your job is already hard enough as a buyer's agent, never mind having to then ask the seller to pay for your buyer's closing costs. So when we're going in with that ask to the seller, we're going to try to keep that number to the smallest amount possible. So again, just huge point, but make sure your buyer's lender does that. No one else in the transaction should do that. There's really no way you could accurately do it. I mean, it's pretty hard to get to that number. You have to have a lot of knowledge. Okay, USDA. So we're all in different markets, but I'm going to pick the common USDA areas that I know of in each local area. So if you're in Schenectady County, USDA territory will be Maryville, Duanesburg, anything basically west of Rotterdam Junction. If you're in Saratoga County, half of Ballston Spa. In the Mechanicville, Stillwater area, Malta, some of the areas surrounding Saratoga. So you're looking at like Charlton, well, actually, no, like Greenfield Center, like that kind of stuff. Those are all USDA. If you're in Albany County, you think of the hill towns, Bern, Altamont, Knox. So Rensselaer County, out towards the Grafton area, kind of like west of Troy. Now, if all those areas I mentioned, they're more sparse. It's based on population density. So USDA is a financing option that does 100% financing. So again, Craig, 100% LTV. We love that LTV word. 0% down. So the buyer gets into the transaction without a down payment requirement. They just have to cover their closing costs. But like FHA, this thing does something cool too. 6% seller concession. So the cool thing about USDA, if the home is in the right area and your buyer qualifies for this, and it's owner occupied single family only. So just, bear that in mind. And you'll have this stuff for reference material, but that's written there too for you. This type of financing will get your buyer into the transaction with the least amount of money out of pocket. It's a pretty cool option. And another version of that would be this, which is the VA home loan. And for VA, it's also 100% LTV, 0% down. And their seller concession rules, they get kind of wacky. There's like this weird calculation where it's 4% of some and all of the other. So, if you just think 6% seller concession, it's pretty much going to cover you too. Like you should be okay. They use the conventional lending limit. So they'll go to 548,000, which is huge. And they'll do multifamilies. So you could do a 2 or 3 or 4 unit, but that person who's served their time in the military and they have the right length of service. So it's only a handful of years if you were active duty, traditional military, Army, Navy, Marines, like that kind of thing. If you're National Guard, you need a little bit more length of service. So it's typically 6 years for National Guard. With the length of service that qualifies, and we can help the veteran check with the VA system to see if they meet the criteria. But this program is awesome. It's 100% financing, and it is the cheapest program with the least amount of money out of pocket because it doesn't have any monthly mortgage insurance. So, veterans deserve it. If they've done their time, they serve their country, they have an awesome loan product to show for it. A lot of veterans are not aware of how good a program it is because, for good reason, I think we do things right in this country, but I think we drop the ball in some areas with our veterans. I think job placement after service has been an issue. I'm just stepping aside from mortgages for a second, give my own personal opinion. I think the VA healthcare system could use some improvement. So, in talking to a lot of veterans over the years, a lot of them think that this benefit isn't as good as it is because of their experience with other VA-related benefits. But this program is insanely good. So if you have a veteran and they haven't considered VA and they're like, I just don't think it's that good a program, it's really good. The only time we're not going to use VA is if someone has excellent credit and a lot of money down. Probably conventional will be a little bit better. But we're talking a lot of money down. To really make the VA program worse than conventional, you pretty much have to have like 20% down. And how many people have 20% down? I mean, $200,000 home, that's 40 grand in down payment plus your closing costs. So for your average buyer, this program's pretty awesome. Okay, investors. Investors are allowed. You can buy homes and not live in them and make them completely just, a business endeavor. And if you're looking at 2 to 4 units, which is really the space that most investors play in, because that's where you're going to get your biggest return on investment, no pun intended. But, if you're buying a house and paying for a mortgage and taxes, you want a lot of income coming in to make that transaction worthwhile. So the 2, the 3, the 4 units are really where you're going to be playing, in that space. And that's going to be 25% down. So for investors, the hardest issue is the down payment. There's no creative way around it. There's no what if this, what if that. It's 25% down. You can't get around it. Trust me, I've thought of every loophole. It's what I do. Can't do it. You just got to do it. What you can do, though, is you can leverage other properties. So if somebody owns a home and they have a ton of equity in it, they don't have to sell their house. They can cash out refinance. They can do a home equity loan, and they can pull the money out of their current property and use that for the down payment on the investment property. So totally cool there. We do construction financing. It's pretty common for a lot of banks. What's not very common is that depending on the builder, we can do up to 265 days. And it's basically the same interest rate. So we're pretty aggressive in the conventional space. If someone's doing a panelized or modular construction home, that's very tough to finance, very tough. A lot of banks don't do them because we have to provide checks disbursement checks during the build process to reimburse the builder. And we do them. So if you have someone doing modular construction, especially if they're building on their own land, they need a special conventional construction mortgage, and we do that financing. Okay, talk about credit score. Before I do that, I want to share this here. This will take me just 1 second. Stop share. There I am. And here we are. Okay, and let's see if I can make this just a little bigger. Okay. So my conversation on a daily basis is, what's my credit score? What does that credit score get me? What's a good credit score? You know, I pull probably an average of 3 to 4 credit reports a day. And looking at these credit reports, I have to make decisions or help buyers make decisions on what to do for financing. So this is from Experian. And when we pull credit, we're pulling three bureaus. Can anybody name a credit bureau?
Sunmark.
No, that's a credit union. Gotcha.
Oh,
Experian.
Experian, TransUnion, and Equifax.
Man, Craig gets like A+ and like 3 extra gold stars. Congratulations. That's it. Yeah. Experian, TransUnion, and Equifax. Those are all 3 credit bureaus. In the mortgage industry, every bank that I'm aware of pulls all 3 bureaus, and we use the middle, which is the median. If you remember like 7th grade math, the median is the middle score. We use the median score as their decision-making score. So theoretically, a buyer can have a 550, an 800, and a 720. And we're going to use 720. And you may wonder, how the heck can somebody have 3 scores that range in, between 550 to 800? Well, it's not that hard, actually. You can have, 3 collection accounts that were held with, there are 3 medical collections you weren't even aware of. And for some reason, they're only reporting to 1 bureau, because these are for-profit companies. What you may not be aware of is Experian, TransUnion, and Equifax, although they are bound by very strict federal laws, they are private companies. And the companies that report that data to Experian pay them a service for that. And they do it because it's accountability. The reason why your Chase credit card gets reported to Experian, TransUnion, and Equifax is that it's a system that you're going to have to rely on the rest of your life for other lending decisions that will be made on your behalf. And it holds your feet to the fire. So they will willfully pay each month Experian and TransUnion to report your scores and report your data, because if you stop paying your credit card bill, they know that you're going to have a lower credit score. So it's worth it for them to do that. But sometimes some companies only report to some bureaus. So you will always have a little variance. The other thing too is that the scoring algorithms vary a little bit from company to company. How Experian does it, TransUnion and Equifax, even if they're looking at all the same data, is different. What's even more dumbfounding is that there are 3 different scoring systems. You have a general score, a mortgage rated score, and an automotive score. So Kelly, you can go apply for a home, apply for a credit card, and shop for a car on the same day, and you will have 3 different scores through Experian, because there are 3 different systems. So when your consumer says, I went online, I did Credit Karma, and Credit Karma says I have a 640, just let that buyer know that when they apply with a lender, it will be a little bit different. When they apply for a mortgage, it will be a little bit different. Not always higher or lower, it can vary. It does depend on a lot of variables. So let's talk about the ranges. Exceptional is what I love, because 800 scores make my life easy. You're going to get a great rate. It's going to be easy to approve you. I love you. We will be best friends the rest of our lives. I love 800 credit score people. Where a lot of people fall in.
Oh, you love working with Ryan Clark, huh?
Oh yeah, absolutely. Ryan's friends, they're like 900. Somehow they're over the chart. I don't know how it happens. This is where most consumers are, between 740 to 799. It's 25%. And then you have good, which is 670 to 739. So for people who are looking in the conventional space, we're traditionally going to be falling into this category, and absolutely exceptional, right? It makes sense. The FHA space is really well suited here. And the reason why is you can have a 670 credit score and have probably no problem with approval at all. But if you try this 670 with conventional financing, the interest rate's going to be a lot higher. If a bank is saying our best rate today is 3%, that's this space. They're lending 3% for these people. They're not lending 3% with a 670. 670 indicates a higher rate of default, just statistically. So they're going to grade that interest rate based on that. FHA's grading system is a lot more fair, in my opinion. And bear in mind, these grading systems, they're not actually set by, for the most part, set by lenders. They're set by the industry as a whole. Remember I talked about Freddie Mac and Fannie Mae, and I'm like, yeah, they make up the rules. Well, they don't just make up the rules. They actually make up like how pricing goes. They kind of make up the systems that say why a bank would go from 3% to 3.75 for a 670 score. They kind of make that rule up too. And then, you know, in this space here, fair, yeah, you're 100%, you're almost wholeheartedly going FHA here. This is where FHA really is kind of lending, where, you know, conventional financing is just not available. And then anybody below 580, they're on life support. Like they really need some help to improve that credit score. And buyers in this space, you're talking months to maybe a year to really improve them to where they can get into, you know, hopefully the good category, which opens up options. So I'm going to stop sharing that real quick. Let's get rid of that. Let's go back to the other guy. And we are getting to the end of this presentation. So what makes up a credit score? Well, I've probably told you already like a dozen facts about the credit industry you were not aware of, but what's completely infuriating to me is that, you know, all of us have gone through some form of education in our lives. And I will wager a bet that I'm probably the only person who's ever received formal training and education on credit. And none of you have really, you know, you learn how to bake a cake in civics in home ec, but no one ever told you what's a credit score. To me, that is insane, because those three numbers will dictate the rest of your financial life. Now, the good thing about credit is that nothing's permanent. Even a foreclosure that lives on your report is not there forever. It goes away after a certain amount of time. So there are fixes to your credit. Now, 35% of your score is payment history, your ability to pay things on time. If you're a slow payer or have a lot of loans in default that are in collection, that's going to be a problem. Automatically, 35% of your score is being tarnished. 30% of your score is what's called credit usage. And this is very heavily weighted, I think, in my opinion, a little stronger than it should be. But I understand the logic. If you have a store credit card, by the way, store credit cards, they're terrible. They're the bane of my existence. Don't ever use them. They're the worst thing in the world. Use them to get the like free benefit of like those jeans at 50% off, and then pay that thing before the bill even comes out, and never look at it again because it's the demon. So here's the reason why. You can have, let's say, a Capital One credit card. That Capital One credit card has a $5,000 limit, and you owe $1,000 on the Capital One credit card. But you have a store credit card with, I don't know, we'll use Macy's, right? So store credit card with Macy's. And that store credit card with Macy's has a $500 limit. And you went and you bought a whole bunch of clothes, and you have a $400 balance on that credit card. You are at 80% of that credit card limit with Macy's. Even though it's only $400, that card is hurting you more than having $1,000 on the one that has a $5,000 limit, because that card only has a 20% usage or utilization. So the problem with store credit cards is that they often have very low limits, and it's really easy to get to a high percentage on those. So what I recommend you do is, if you ever need to use a card with a low limit, use it as soon as the balance reports, pay it before the end of the billing cycle. because does anybody ever get an email from their credit card company that says, we've noticed a change in your score. Log into your account to take a look at what your score has done. Like I have 3 different credit cards that give me these free score services. And I pretty much know what happens, but I go on vacation, I charge a few grand to a credit card, and then I forget to pay it before the end of the billing cycle. And I have a high utilization. Well, for that next billing cycle, I have a high utilization on that card. But by the time the next bill comes out and they re-report it to the credit bureaus, which is the next 30 days, I'll have paid it off. So the trick to the usage is, if you ever know you're applying for a mortgage or going to buy a car, go in, immediately pay all your credit cards down and hopefully get them down to very low balances before the end of the billing cycle. So that's the trick that I employ. Someone comes to me and they are, let's use the example of like 670 again. I think it's a really good number. And I can tell that they're utilizing some of these credit cards poorly. I will say, you know what, pay these 3 or 4 accounts down. It's not going to take you a lot of money. You have it. Let's do it. Let's wait 30 days. And by doing that, when the bills re-report, now their credit score just went up to 720. Because as it says here, your percentage can be as much as 30% of your score. So be careful with credit cards. They're fun. They're easy. They're like the way we live. It's 2021. But, again, just know how the system works, because it can bite you. Okay, 15% of your score is length of history. So Ray, if you have, a few credit cards that you've had for a few years, don't close them, keep them open, because they're part of your overall history. What's really tempting is, you get a new credit card, you're like, I don't need the old one anymore. I like this one better. It's got a better APR. You know what? You might want to consider just leaving the other ones open. Eventually they may close them if you don't use them at all, but having accounts that are in good standing, that have been open for a period of time, contributes to 15% of your score. Establishing new credit is a problem. I jokingly once a year will throw a post on Facebook saying, like, don't buy a car if you want to buy a house or you're going to live in it. But there's truth to that statement. If you go buy a car before you buy a house, that new car just hit your credit and it's new debt. And just the presence of it alone can drop your score as much as 10%. And then there's some other factors, which is mix of credit, how many accounts you have. And even within this 10% are credit inquiries, which actually carry very little weight. People are often very concerned about things like credit inquiries, but there's so many other factors that actually come into play that affect your score so much more than that. Okay, this is one slide that I've decided to throw in here. And it's an important one that there's a lot of stuff on here. I'm not going to go through all of it. I just want to make a point on a few things. Things like short sales, foreclosures, and bankruptcies can have very serious impacts on someone's ability to buy a house. So I'm going to make it a little bigger so I know Megan can see it here. Anyone know what a short sale is?
A short sale is, we were just going over this too. Short sale is like, selling a house before it goes into foreclosure. Kind of. Maybe?
It could be. In a lot of cases, short sales do also involve someone being behind on the payments. But someone can be completely on time with all of their payments and still go through a short sale. You haven't run into short sales recently, and for good reason. Home values are rising. But I've been doing this long enough where when I started in the business, I had hair. So, I've been doing this a long time, and I've gone through the mortgage crisis. I was in this business in 2005, and it was great in 2006. It was great in 2007. And then the bottom fell out, and the mortgage industry created a big problem for the rest of the financial industry. And we went through the Great Recession of 2008. And that was a scary time, because in 2008 and 2009, and a little bit in 2010, home values dropped. So some lenders were doing loans where they were lending to high loan to values, and then assuming those home values were always going to increase. And then the bottom fell out. And now they want to sell 2 years later, and they realize they're underwater. They owe more than what the home is worth at that time. So they may owe 200,000, but because home values had dropped, the home may only be selling for 180,000. But what happens? They have a mortgage of 200. So they go to closing and the bank says, well, you owe us 20 grand. You still have to pay off your balance. I'm sorry, you can't sell the home for what you thought it was going to be worth, but you still owe us as a lender 200,000. A lot of people can't do that. So right to your point, that person they might still be making their payments on time. So they're not a foreclosure risk, but they don't have the 20 grand. So they're stuck between a rock and a hard place. And what short sale is an agreement between the lender to take a loss of 20,000 to keep that transaction together. And it requires a separate appraisal, short sale approval. It's a nightmare. The processes have gotten a little better because it was a new space for the industry to work in 2008, 2009. And I think the banks kind of have systems now that they can do them a little cleaner. But, we may see another downturn in the market. Maybe it's 2023 or maybe it's 2030. Like, who knows? There's always going to be an ebb and flow. And eventually in your career, you'll run into that situation where home values will drop. And if that happens, that's a short sale environment. So if you have a short sale, there are times where people have to wait for conventional financing. You might have to wait 4 years to do another conventional loan, FHA 3 years, but it can actually be 0 if we can prove that they've been making their payments on time. So this is that point when I'm so glad you said the foreclosure thing, Ray, because often those two things do come together. They are part of the same process. But if a buyer has been on time and they're doing a short sale, FHA will actually they will not make a distinction. They will be completely okay with the short sale. VA, no specific guidelines. So it's kind of up to the lender to decide, which is a little wacky, but we're pretty liberal on that. Foreclosures. This is one you're going to run into a lot. Somebody has had a foreclosure 7 years ago or 6 years ago. They can't do conventional financing for another year. It's 7 years for conventional. FHA is 3 years, and then bankruptcies. So there's 2 different types, and each program has different guidelines, but it's going to range between 2 to 4 years. And the bankruptcy thing is a problem because people have gone through a bankruptcy, they've cleaned up their credit, they're on the up and up, right? They're getting their life back in order, but maybe it's only been a year. The problem is they're going to have to wait another year because it's 2 years is the most liberal guideline for that. Unless it's a Chapter 13, then there are some extenuating circumstances.
Bankruptcy stays on your report for like 7 years.
So they do. It can be 7 to 10 years for bankruptcy. They can live on the report, but that doesn't still prohibit someone from getting a mortgage. So as long as, we'll see the bankruptcy, because if I pull a credit and somebody has had a bankruptcy 4 years ago, I'm going to see it. It's on their report. But then we have to make sure that in addition to all of the other guidelines I need to know, I have to then specifically look at the FHA, bankruptcy guideline 2 and look at the dates and ensure that we're okay. And there are 2 different kinds of bankruptcies. Chapter 7 is when someone says, I'm free and clear of all of my debt. All of those creditors have all been cleaned. The judge signed off on it, and I do not owe anybody anything. Clean slate for me. It's going to live in my report for 7 years, and that's what it is. Chapter 13 is when you got behind on those debts and you're restructuring payments. And you're entered into agreements with all of those companies to pay them back, usually not the full amount that you owe, but some amount. And there are easier guidelines for a Chapter 13. Unfortunately, more bankruptcies are 7s. So just kind of is what it is. This is a really helpful document. I would not say that you should be the expert on this or discourage anybody who doesn't appear to meet these guidelines. They should always get the real advice from a lender because there are extenuating circumstances and these rules are subject to change. So if you said to somebody, no, it doesn't look like you can, but the rules just changed 3 months ago, you don't want to turn someone away. But this is really helpful stuff. So I'm going to send this one to you too. And we're just about done.
Everything you have here, right? You're going to send in a PDF?
Yeah, I'm going to put this all together and I'll blast it out to everybody. I'll get all the email addresses from Ryan.
Awesome. Yeah, I believe you have mine though.
Yeah, yours.
Now that's short sale. Now back to short sale. Sorry, now the original mortgage will will come up to an agreement to actually take a loss, or are you talking more like a junior loan would be negotiated, then the original mortgage would be paid?
Okay, that's great. So that's a twofold in question that actually is pretty smart. If it's one lender, that lender agrees to take a loss. And just to use an example of a local bank, let's say Trustco Mortgage did a mortgage for somebody, the market values drop, and now somebody's underwater by 20 grand. They owe 20 grand more than the house is worth. They're going to have to go to Trustco and say, are you willing to take a $20,000 loss? Because the alternative, it's kind of like, I hate to use the example, but it's kind of like the buyer holding a gun to Trustco's head. They're sort of saying like, take a $20,000 loss, or I'm just going to let this thing go. Because, you know, I mean, if somebody can't come up with 20 grand, they might just walk away.
It's an ultimatum.
Exactly.
Blood from a stone.
Exactly. So banks sort of realize, well, okay, I think we can do that. But the banks they got smart too. They put some stopgaps in place. They realized, you know, they may require their own appraiser too. They want to make sure that people are not taking advantage of a market situation. They want to make sure that it's an arm's length transaction, that they're not selling like Ray, you know, you're not the seller who's 20 grand underwater and selling to your sister. I don't even know if you have a sister, but we'll say you have a sister and you're selling the house to your sister because now it's like this family situation that looks like collusion. You know, they really kind of look into the nuance to make sure that it's not someone take advantage of the market situation. But they've gotten kind of wise to it, which is good. They should eliminate fraud wherever they can. But yeah, Megan, it's an ultimatum for sure, because the alternative is typically foreclosure. Now, Ray, you mentioned a junior mortgage. Now, what a junior mortgage is when someone has a first and a second mortgage. And this will be really important for you if you're a listing agent down the road in a short sale market where home values have dropped. You want to ask, if we're in a short sale market, you want to find a way to get this information from your seller. How much do you owe? That's a really important number to know, right? Not that you're going to make that the number to list their house for, because the market will support what a house should be listed for, right? That's why you do a CMA. But you want to know what you're getting into, because if they owe money and they're upside down, but let's say they have two mortgages. Now there's a short sale agreement with not just one lender, but two. And that is definitely as fun as doing your own root canal. So be very careful about expectations. And I'm not saying, you know, turn that deal away, right? Because a deal's a deal. And especially when you're newer, and it doesn't matter. I mean, you could be Frank Callahan. You can write a zillion deals a year. A deal's a deal. Everyone wants as many deals as they can get. So don't turn that deal away. Just know what you're getting into and give your client clear expectations, because now they not only have a short sale agreement with one bank, but two. And that lender who's a junior lien or in second lien position, the home equity lender, they may get nothing. They may get zero. So negotiating that one could be a real hardship. So there, it's could be a tricky situation, especially if there's two. It's easier with one, I will tell you that. All right, this is the last slide, and then I think we're good. I will show you probably one more quick thing. It'll be 2 seconds on the other one, but this is a common list of stuff that we might need. This isn't everything we need from every client for every transaction. If it was, it would be a little over the top. But the common things we need to actually do a formal application, whether it's that pre-approval or someone's under contract for the home and they are ready to apply for that house. We're looking at photo ID, social security card, pay stubs, W-2s, sometimes tax returns. We don't actually always need them. If someone is divorced, separated, we do need some of that paperwork, and we definitely need bank statements. Other than that, the rest of these things are kind of like, depending on the transaction. And there can be more. Someone's on fixed income, we might need 1099s. You know, there are other factors involved, but you know, probably a third of this list are the common items that are on just about every application. So good for you to know that stuff there. All right, this is the last one. I will include this too. We do have information on grants. So I talked before about that buyer, 200,000, they saved 7 grand. We were the biggest jerks in the world telling them they needed 17,000. They hate us, they hate life, they're discouraged. They realize seller concessions not possible in this market. They don't have any family that can give them any money for gifts. They want to just live in a cardboard box the next 30 years or their parents' basement. But then someone says, there's a grant. So if someone is a first-time home buyer, there are all of these places that offer potential grants for people. So Greene County, Catskill Mountain Housing Development Corporation, Albany Housing Authority. Let's see, where is TRIP? For some reason, I don't see TRIP on here. I may have to update this one. Well, in Rensselaer County, there's TRIP, which handles theirs. Schenectady County, City of Schenectady, their website is really the best place because they seem to change the funding sources from time to time. They're currently working with a different organization, but the point here is this. There is some free money. And actually the town of Colony has one of the best ones. I mean, I think it's up to $20,000 potentially someone can get. What's most commonplace is around 10 is kind of the average. Okay, here's City of Troy. Housing and Community Development, but TRIP, T-R-I-P is actually the acronym for the organization that Troy uses. So the grant funding is there to help first-time home buyers gain access to the funds they need to pull a transaction together. Here are the pros and cons. Pros, free money. Go get it. I mean, there's no reason not to go get it. The cons are this. It's not always available. So you can run into a situation where the buyer needs these funds. And if the funding is not available, there's nothing you can do. And the other negative is this. Every one of these that I've worked with, they will not allocate money to you and then tell you to go buy a house. It's definitely cart before the horse. You have to get under contract and then take the contract to them with your documents and apply for the grant. Now, if they say you don't meet the criteria or the funding isn't available for the next 4 months, you're SOL. If the buyer needs the money, there's no way around it. So my recommendation for grants is make it a hardship, reason that the person needs to get it, obviously, but try to see if there's a fallback. In the event that the grant doesn't work, can you get a gift instead? Is there anything else? If the buyer says no, at least you know what you're getting into. Like the deal may not come together, the house may go off the market and they may have to find something else when the funding is available again. But in most cases, the people who work for these grant companies, one, they're overwhelmed. They are working crazy hours. They're civil servants. They're probably underpaid. They're doing God's work. They are awesome people. I know so many of them. They are just as frustrated when a deal can't come together. So have your buyer make some good connections with these grant companies for the areas of interest that they're interested in, and at least have an open line of communication, because a lot of them will be a little more transparent if your buyer's been able to make some connections with some of them. But they will tell you, like, we're not going to allocate funds for you or anything until you're under contract. So that is the scariest part of the grants, but it's awesome money and there's a lot out there. So make sure your first-time home buyers are looking for that. I send it to any buyers I work with who I think could benefit from it. And if they decide to go down that road or not, it's up to them. But at least the option's been presented.
Also, too, when you are granted with those, isn't there like a minimum 5-year you need to be in the home too, like after you're approved for those grants?
Yeah, in a lot of cases, yes. So what that requirement is designed to create home ownership stability for the market. Let's use City of Schenectady, for example, which has that 5-year requirement. And me living in Schenectady County and doing probably half of my business in Schenectady County, I do half in Saratoga and half in Schenectady, just by the nature of my referral sources. And I'm a big fan of Schenectady and their home revitalization. So I do a lot of work there. They have a 5-year requirement. What that means is they want you to live in the home for 5 years, owner occupied, because owner occupied homes generally are better kept, right? I mean, landlord versus homeowner, it's human nature. So
yeah, especially in Schenectady.
Yeah, exactly. I mean, everywhere, even Albany too. I mean, they're dealing with the same burden. It's a problem, but yeah, definitely Schenectady, 100%. So they want people to live in the home. Now, if you get relocated with your employer in 3 years, they're not going to foreclose on you. That's okay. What they're making sure is that you're occupying it if you own it. So if you own it and then convert it to a rental in year 3 and the city finds out, that's a problem. That's a major problem. You don't want to do that. So there are some requirements. Definitely have your buyer read the red tape. It can vary from place to place because the city or organization that's granting the funding can make up whatever rules they want as long as they're legal. So have them read the fine print and make sure they know what they're getting into. But the strings that are attached are very few and far between. I think it's definitely worth getting a grant. If I was a first-time home buyer, I'd get a grant. Why not? It's free money. This is it. What's that?
Say go for it if you can.
Yeah.
Even if you're not depending on it, just go for it.
Yeah. Somebody's got their hand out. Take it. Grab it. Okay, we're at the Q&A part. Any questions? I know I threw a lot at you. There's no test, so you're okay if you forgot like 90% of it. That's why we're here. We're here to answer questions later on. So if you don't have questions, the only thing I will leave you with is just the promise that there is always an open line of communication to all of us at Homestead whenever you need us. It doesn't matter who your loan originator is. Each of you have your own assigned person at your branch. But, Ray, you can decide tomorrow that you hate me, even though I am, in your branch, and you can work with whoever you want in our company. We do not care. But we are all here to help you. So if you ever have questions on anything mortgage related, and like I said before, even if it's not a deal that we're working with, pretty much I can speak for all of my colleagues. We all enjoy just the mortgage process. So we'll answer questions. If you have a deal with another bank and you're like, this doesn't seem right to me, my buyer is frustrated because of X, Y, and Z, ask us. We'll let you know. Sometimes they are frustrated, but they just have an unrealistic expectation. And it's nice to hear that whatever stuff they're going through just is what it is. And then there are times where that's not right and they should absolutely get a second opinion, but that's why you have people to go to. So hopefully we can be those people. One last thing, especially because you're all new, you're all working on ways to market yourselves. And Ray and I have actually done a little bit of work already on some of this. So if any of you need help with marketing, whether it's postcards or door hangers, or you're doing open houses and you want to make nice fact sheets, go to your loan originator in your branch and ask them for help. If you've never met them before, it's completely fine to say, hey, Janet, I've never met you before. Phil said you guys do marketing. Tell me what I need to know. It's completely free. We do not charge for it. We are here to help you market yourselves. It's a joint marketing piece. So we're going to share information about Homestead with whatever your needs are, whether you're looking for buyers or you're trying to promote a listing. We do it as a joint piece of marketing and we can help you with that information. So let us know how we can help you, and we certainly will.